Welcome to our weekly market update. My name is Chris Marshall. I'm Head of Investment Strategy here at Dragon Investment Managers. So I'll take you through some of the salient points that we've seen over this week's trading sessions. I think if we start with markets, we've seen UK and Europe really trade with a lot lower volatility and kind of going into Friday's session, we're roughly flat for the week. As we look around the rest of the world, US is slightly down so far. They have got one more session ahead today, but S&P is down just under 2% after some disappointing news on a potential viral treatment yesterday. Asian markets are on the whole down. The amount varies, but Nikkei 225 really kind of leads it down about 2.5%. I think the low amount of volatility we're seeing in markets, however, is astonishingly surprising and shows the level of optimism that's still left in the markets. Certainly when we look at the backdrop of really eye-watering and horrific economic data around the world, which is starting to come out. So in the UK, for example, earlier in the week, we saw Capital Economics come out saying that their models suggest that we could easily jump from 4% to 9% unemployment. I mean, that's a massive print difference, and this is in the face of so many policies such as kind of payroll support and furloughing workers for the UK. And again, we see a very similar theme occur in the US. So for the past 4 weeks, we've seen very high, historically record-setting numbers in the initial jobless claims. We've now seen 26 million initial jobless claims in 4 weeks. And those numbers actually represent 16% of the entire US labour force. And so these are really huge numbers that we're seeing come through. A lot of the economic surveys and data at this point are really less meaningful than they would be in a normal environment, simply because if we look to PMI data and things like that, which look at kind of activity and pricing, both in the services and manufacturing sectors, well, we fully expect those to be a lot lower than normal, simply because the policy measures being used around the world are to retard coronavirus growth through really social and economic activity suppression. And so some of these data and surveys are going to obviously show very bad numbers. Now, two perhaps which are different to that and give us some real insight still are consumer confidence surveys. They do show how people are feeling, and also oil price, which of course is a very real-time economic indicator. Starting with the consumer confidence, we saw the UK's consumer confidence survey come out. That fell to -34. It's only 5 points off its lowest ever, which was set in July 2008, -39. And when we looked at oil, we see a very similar story. We see the May contract, so this was on Tuesday this week, collapsed to a minus number for price on barrel of oil. It's the first time this has really happened. We got to -37.6 for a barrel of oil, and this was really showing just the risks of the supply cuts are just insufficient to meet the demand fall. We've seen roughly a supply cut of about 10 million barrels of oil against a demand fall of about anywhere between 25 and 35 million is the expectation. And at the same time, we've seen the world's oil storage facilities essentially fill up, and the question really coming through of where does all this oil go to? Where does it get stored in the meantime? And so these are giving us some really good insights as to kind of perhaps the economy is actually performing far worse than people are expecting. So why is there still optimism in markets? Where is that coming from? Well, I think it comes from both the slowdown in growth of coronavirus infections. We've seen a lot of countries now starting to reopen, although some of them have hit some early roadblocks. We've seen Germany have 3 days of rising infections, nowhere near the amount that they had at the peak, but these are some issues which countries are going to have to work through and really kind of look at the detail and do it in a very slow approach. And I think The comments we saw from the UK's Chief Medical Officer, Chris Whitty, reflected that, just saying that it's wholly unrealistic expectation to think that when lockdown is lifted that we just snap back to some sort of normal social life. But markets are taking the optimism that countries are at least trying to reopen. Some sectors of the economy are restarting, and this is really giving the market a little bit of an optimistic boost, if you like. We've also seen some positive news come through from testing. So the US, or New York State, did a random antibody testing. It came out showing that 16.7% of people in the study seemed to have markers suggesting that they'd already had coronavirus. This is both good news and potentially bad news in a way. The good news is, of course, that mortality rate would be suggested to be far, far lower than previously thought. The bad news, of course, is still it's a very small amount of the population which have had it, and that small amount of the population really still placed massive strain on the medical infrastructure. So other areas where markets are kind of taking a bit of an optimistic boost from is the continued, almost relentless policy and central bank stimulus measures coming through. So we've seen central banks continue programs buying up assets which they've never bought in previous market downturns. ECB buying lower grade credit. We've seen a very similar thing happen in the States, where the US Fed is participating in both the primary and secondary corporate paper markets, as well as buying up some of these corporations which are falling victim to downgrades from ratings agencies. Now, this is putting a floor under some of these asset prices. It's providing markets with quite a lot of confidence in terms of that the financial system is going to keep flowing. And then you add into this some of those fiscal policy measures that we've seen. So we saw the EU endorse last night a 540 billion euro plan. This is in addition to a further between 1 trillion euro and 2 trillion longer term plan, which is still having a few difficulties, but is still in the pipeline. Again, we saw the US pass the aid bill, which is $484 billion of new aid. And in addition to this, we look around the world and we see a record number of central banks cutting rates. In the 2007 and 2008 great financial crisis, we saw, I think, 29 central banks cut policy rate. We've now seen 31 come out cut policy rate. And so markets are still taking an awful lot of optimism from these measures, which hopefully provide us with this suspended animation scenario of that the economy can be kind of paralyzed for a time while coronavirus is really trying to be dealt with, both in medical infrastructure and hopefully treatments as well. But I would stress that there are some potential roadblocks and stumbling blocks with that, and that's certainly how we are positioning our portfolios. That we are taking defensive stances still with some fairly high cash positions, which we think is right, but also deploying some assets into some of these opportunities which we see presented to us. So for another week, that's the market being wrapped up for you. From myself and all my team at Dragon Investment Managers, we wish you a very healthy and happy weekend, and we will be back next week.